Hello, everyone, and welcome to the Upfront Radio. I'm your host, Suha Beidas Zehl, and this is the show where we get real about the mortgage and lending industry. Straight talk conversations with some of the sharpest mind in the space. And this is our first episode. I could not be more excited about where we're starting and who my first guest is. She is someone who has spent her career not just working in mortgage, but actively reshaping it. She is the SVP of Correspondent Lending at eRESI. She's held senior executive roles at some of the most recognized names in fintech and mortgage lending, including NewRez. Honestly, her fingertips are all over the growth of non-agency lending as we know it today. Please help me welcome Lisa Schreiber to the Upfront Radio. Lisa, it's so great to have you with us today.
Hello, Suha. I'm coming to you from the New Jersey MBA in beautiful Atlantic City this morning.
Wow, that's awesome. You're speaking there, right?
I am. I'm on a panel today about non-QM and non-agency production.
Well, that's a perfect transition into our first question, Lisa. The non-QM space is shifting really fast right now. In your opinion, what's really driving that? And why is this the right moment for non-QM lending?
It's just like a perfect culmination of things that happened almost all at the same time.
Yeah.
We have certainly, when I first started in 2015 doing non-QM, quite a long time ago, At that point, agency production was pretty high and people were very focused on just doing their normal production. So we were trying to educate people around the products, the opportunity, but it was really challenging. So over the years, we've been educating. And then COVID happened.
Yeah.
At that point, we certainly saw a break in the non-QM space, mostly because of the securitization market at that time. But what we also saw is a changing borrower. So many borrowers and even people that had lost their jobs became entrepreneurs, or the entrepreneurs really became much more effective because they became much more creative. And then people started doing a lot more from home. So we had a borrower shift, a lot of more gig workers and things of that nature. Additionally, we saw the advent of rental income becoming a source for income, as well as a lot of people couldn't really afford a home and began to rent more than ever. So the rental market got hotter, the gig worker and the borrower themselves shifted. And these products became, as people understood them, became much more relevant to the current borrower solutions, basically.
Yeah, I mean, we know that, with COVID and with, all the downsizing that's happened in our industry, people, really did kind of like become their own businesses, if you will. And
they're their own
like
boss.
you said,
Yeah.
they're their own boss. And so you're getting all of these different types of borrowers, and that doesn't really fit that agency box, if you will. And, you talked about COVID, you talked about borrowers. We kind of have seen that the non-QM market really didn't just emerge by accident because of all of those things that you talked about. And you do have that 10-year, 11 years in this space is quite a long time. You probably have your hands around it better than anyone. We saw a lot of regulation, from Dodd-Frank during the crisis and, today's market with the rates and everything that's happening there. I heard you speak recently at the IMB conference on a panel with Kevin Piranio and others. And one of the things that you guys talked about is advocacy and the education piece. How intentional have you been about advocacy throughout your career that's leading to this perfect storm that we know is happening right now? And what does the industry risk if we don't really follow through on this, if this engagement fades in the non-QM space?
Yeah, it's interesting because I don't think it will fade. And when we were talking about borrowers, Suha, I should have mentioned you and I, right? Because after 2020, I went back into consulting and I became my own boss. You as well. So it's just really interesting, all the aspects of that. But as far as the education piece, I talk to people all the time. I try to focus them. And one of the things that Kevin Brano said at that IMB panel is how he focuses his team on more of the basics, right? What are the programs that have the biggest potential to help the borrowers and also have become more of really been woven now into people's production. So those would be things like bank statement loans. Those are seemingly very easy to understand. You're taking 12 or 24 months of cash flow utilizing tools like Prudent AI's income
Yeah.
calculators, right? But really, once you have that income, it's a regular loan. Like everything else really just
Hmm.
flows. And then same thing with DSCR, it's a cash flow loan. So again, if I'm buying a income property, we need to make sure that that income that I'm deriving from that property is not only meeting my mortgage needs, but also, in many opportunities to exceed. It's really just what are the main programs, educating, focusing, getting people comfortable, confident. And there's a
Hmm.
lot of ways to do that, right? You can do it yourself. You can lean on an investor like me to help you,
Hmm.
which we do an awful lot. And I think we should probably talk about that. How different it is in the non-QM space than an agency space. Because in an agency space, nobody's training you every day. Nobody's
Yeah.
really working deals with you every day. There's no need for that. But in non-QM, that is the key to success. Having a partner with good liquidity, ability to help you structure deals, ability to look at exceptions when they're needed, and ability to support your efforts in educating around these programs.
It sounds, the way you're talking about it, it sounds that advocacy is kind of like a trident. One, you have to educate the borrower on these products. Two, you have to educate your originators to understand what products are available and how to best advise their customers. And then that advocacy, that education piece is when you become the partner helping those lenders help those borrowers. So it's kind of like a triple domino effect, but it all comes together. As Kevin said, it's kind of like advocacy becomes your strategy. By building that education foundation in all three levels, that really helps you become successful. And, which kind of leads me to the next question, because correspondent lending right now is sitting at a very unique intersection where you're balancing all these needs, the originators and your investors and your borrowers. And, you've seen the market go through multiple cycles. We have the up and down, the rates change, the, affordability and all of that. How do you manage those competing priorities in the non-QM space? And honestly, how do you see what separates those lenders and partners who survive or will survive from the ones who are not going to because they're just standing still, honestly?
Yeah, I think there's a few things, especially from my perspective, right? So at
Mm-hmm.
eRESI, we are more of our money comes more from insurance funds and things of that nature. That's our parent. So we're very strong financially. So one thing that I always talk to sellers about, and in correspondent lending, we're really not working directly with the borrowers, right? We're
Mm-hmm.
helping those that do.
Yeah.
So one thing critical I would say is always make sure that you've got somebody that has financial strength, right? Everybody's in non-QM right now. That's like the buzz, right? Everybody's
Yeah.
doing it. And then a lot of people are just resellers and they may not always have that financial strength. So who are you working with? Do you have good risk, let's see, a profile of that partnership? So,
Mm-hmm.
for example, we tell people find somebody that's got, more of the insurance portfolio money, and then find somebody who also has securitization in their portfolio. The ability to do both is really important. So, financial strength. Then I would say that we definitely support and train a lot. We go out, we train our folks, and a unique thing that I bring, and I know you bring a lot of unique talents to your clients as well, is that I can help people like set up their systems. So, for
Mm-hmm.
example, I've set up Encompass probably 10 times in my life and even worked there for a little while back in the day. And so, setting up your systems correctly, making sure that your doc sets are right, making sure that you understand how prepays work. So it's really truly like money, the financial strength, the ability to help people set up their systems correctly, and
Mm-hmm.
then really just working with them on the deals. Like our scenario desk, our exception desk,
Mm-hmm.
30% of exceptions in general in our industry. It can be a little higher, a little lower, depending on who you're working with.
Mm-hmm.
That takes interaction. That takes people working together, understanding the loans, understanding the process, understanding how to utilize the programs. All of that comes into play, and that all that support goes down to making that homeowner get what they want.
So it sounds like, if I summarize what you just said, which was really a lot of intel there for people who are listening, for our audience, it sounds like to survive, to thrive, actually, not just survive, there's really 4 key things that they need to be looking at the financial strength of the leadership, looking at their risk appetite, making sure they've defined it well, making sure that they have the structured foundation and the right partner to help them set up that structured foundation. So creating that partnership, that collaboration, that communication channel to make sure that they actually are both thriving in this non-QM space, which actually leads me to my next question. We know AI is everywhere, and everything we talked about, kind of you can see where artificial intelligence can actually play a really significant role while keeping that human in the loop. And, everybody's talking about AI in lending conversations. It's at all the conferences. That's what everybody's talking about. But what does it actually change in the non-QM world specifically? Beyond origination, how is AI beginning to reshape on the servicing side of these loans, where complexity really doesn't just stop at the closing table? It goes beyond that. I'd love to hear your take on that.
Certainly. And you're right. It's non-QM and AI. AI. And I always, it's so interesting to me because I'm learning too. Right.
Yep.
This is a learning opportunity for me, and I think all of us. How to leverage these tools, where to leverage the tools. I know I've talked to you about that. You have got a lot of great knowledge there. Simply, right? We start simply, and simply are things like the income calculators, the use of that, chat bots, right? Talking, building an agent relative to your guidelines. We talked about that whole interaction on scenarios and deals, putting them together, understanding. So utilization there, we're working on. We're also working on eligibility, like more of an eligibility engine, being able to kind of read the docs, again, create that environment where people can self-serve whenever needed, certainly with that human right there alongside that technology. I think we can't lose the human just because, especially in the non-QM space, there is so much structuring. There's so much like, tell me more about your borrower. Tell me more about how they get their income. Tell me more about whatever. What are they trying to achieve? So I think it's more for us today, it's probably things like chatbots and eligibility engines. And then, of course, when you talk about servicing, I don't think there's older systems anywhere in the mortgage business besides servicing. So servicing will be very interesting. It's interesting. It's good, interesting and good. I'm a little grateful that I'm not in servicing. It's definitely one of the tougher parts of our business, but I know I've seen tons of stuff around servicing for AI as well. Yeah. And it certainly could be a great benefit to the borrowers, as you say, as they make their payments and work through that.
Yeah, I think, what you've hit on is those low-hanging fruit that somebody in this space can start with, because I think that's the most important thing, is to just start. Look at things that can really help you be better and do better. And, whether it's the income calculators, and Prudent AI is a great example, whether it's the knowledge agents, chatbots that help you streamline your guidelines and become more self-serving, if you will, have more self-service, actually, I should say, not self-serving, but allow your teams to become more self-sufficient, to be able to serve your clients, and then they be able to serve their borrowers much better. So when you look out, like 3 to 5 years from now, where do you think lending, and specifically non-QM, is heading? What's that shift that you see that maybe others are not seeing right now?
Yeah, it's super interesting. As I mentioned, I started in 2015. So the borrower profile at that time looks almost exactly like the borrower profile now, all these years.
Isn't that interesting?
It is so, to me, it's kind of fascinating, especially being in the business so long. All throughout the cycles, we're still running around 70% LTV, even a little less. We're running in the mid to high 700 in scores. It's just really interesting. I don't know how much the borrower profile will change, because I do feel like in all these years with it staying so steady, it is definitely meeting a need, right? If you think about it, it's meeting a need. I think what we do need to be careful of, we need to be careful of not going too crazy right? You know, like there's so much liquidity right now. People are really interested in the programs. They're filling a need. You know, I think that the
Mhm.
amount of business, it looks like I was just at ICE and they said about 12% of their overall volume is non-QM. So
Wow.
that's huge, right? So
That's
I think
huge.
we need to
Yeah.
be careful. We don't get too crazy and start doing, 100% whatever, none of that anymore. Hopefully we've learned our lesson.
Yep.
But I would also say broaden the opportunity. So when we say non-QM, we kind of focus on bank statement and DSCR a lot, but it also includes full doc loans that a lot of
Hmm.
people utilize for jumbo. It also includes, if you would broaden it to non-agency, it includes all of the equity products. And
Hmm.
the MBA says there's $35 trillion of equity out there. So
Yep.
seconds, HELOCs, all of those things. And then, if my friend Tom Davis was here, he'd be talking about RTLs and things of that nature too. So there's just a
Yeah.
very broad set of products, but I think the standards are just going to be completely woven into the product offerings now for borrowers, and we won't even be thinking about them that differently in the future.
Yeah, I think what you kind of hit it on the head there, saying it's kind of like that siloed kind of line between agency and non-agency is really blurring
Mm-hmm.
as we move forward, and I think that's going to continue to happen as well. Lisa, this has been such a really fun and rich conversation. Thank you so much for being so generous with your insights and for being my very first guest on the Upfront Radio. It truly means a lot to me. You know that. And for everyone listening, I hope this gave you something to think about. And if you've enjoyed today's episode, please share it with someone in your network who would learn from it and appreciate it. Make sure you subscribe to get the next episode in your inbox so you don't miss what's coming next, because we have a lot of really great guests to follow in Lisa's footsteps. I'm Suha, Zehl, and this is the Upfront Radio by Prudent AI. See you on the next one.